You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. We've got a really dense briefing here covering global markets, trade, geopolitics, a lot going on. Our job, as always, is to sort of cut through that complexity for you, pull out the key nuggets you need, and do it efficiently. And today, the sources show this real tension. You've got central banks everywhere talking tough on inflation, very hawkish sounds. But then you look at commodities like crude oil, and suddenly there are signals supply might actually be loosening up. It feels contradictory. And all this is happening against, well, rising trade barriers, some really specific ones, and let's be honest, pretty high geopolitical instability.
That tension is exactly what the market is grappling with right now. It's less about broad index moves and much more about, specific policy actions. We're seeing these subtle shifts like in the US dollar, but also these, frankly, quite disruptive trade decisions hitting real sectors, timber, furniture.
People actually buy and use.
Exactly. It's really an environment where policy is driving price action, perhaps more than pure market forces right now.
Okay, let's dig into it, starting with the money flow. Foreign exchange. The U.S. dollar seems to be the starting point. It eased off a bit. Feels like maybe the market's catching its breath after last week. And maybe looking ahead to U.S. data and, the potential government shutdown.
Yeah, that slight dollar dip immediately ripples outwards. You saw the euro, the pound, they firmed up a little. But honestly, the bigger story isn't the dollar pause. It's the hawkish shift we're seeing from other major central banks. That's what the briefing highlights.
Right, let's zero in on that. Like the Bank of Japan, the yen actually strengthened for 3 days straight. Why?
Well, their latest summary of opinions, it had this more hawkish undertone. It wasn't explicit, but the language mattered.
How so? What did it suggest?
It hinted that some members think, maybe it's time to look at another policy tweak if the economy and prices, especially wages, keep moving up. And for Japan, the longtime outlier on policy, even a subtle hint like that gets read as a pretty big signal. Maybe the deflation fight is finally turning a corner.
And Australia, too. The Reserve Bank held rates, which sounds neutral.
But it was the message that came with it. They held rates unanimously, yes, but paired it with a, quote, firmer message on inflation risks.
Okay, so hold rates but talk tough.
Exactly. It's what we call a hawkish hold. Keep borrowing costs steady for now, but signal very clearly that if inflation doesn't behave, hikes are coming. It's a warning.
And that worked. It supported the Aussie dollar.
It did. It allows them to keep pressure on without actually tightening policy yet.
Yeah.
Very strategic.
And speaking of managing currencies, China's central bank seemed active too. The yuan got a boost.
Yeah, the PBoC said its daily fix stronger than the market expected.
Okay, the daily fix. Can you just quickly break that down for our listener?
Sure. So China doesn't let its currency float completely freely. Each day, the central bank sets a midpoint, the fix. The yuan can trade and demand around that fix. When they set that fix stronger than anticipated, like they did here, it's a clear signal. They want stability, or at least they want to slow down any depreciation. Policy in action.
But hang on, if China's trying to project stability, doesn't the sort of background geopolitical tension in Asia complicate that? Our sources mentioned South Korea is still having trouble getting a currency swap deal with the U.S. That sounds like instability, not stability.
That's a really sharp point. You're right. Daily fixes manage the short-term picture. But these bigger unresolved issues, like the lack of a financial safety net, like a currency swap agreement, they absolutely create underlying uncertainty. It reminds investors that, those core stability mechanisms aren't guaranteed everywhere. It adds a risk layer to regional investments.
Okay, shifting gears from currency flows to physical stuff, commodities. You called it a roller coaster. Crude oil is still weak, which honestly surprised me a bit given all the Middle East tension. What's happening on the supply side?
It's really two big potential supply stories weighing on prices right now. First, there are these reports or maybe rumors that OPEC Plus might actually lift their production quotas for October.
Increasing supply.
Potentially, yes. That always spooks the market a bit. Suggests maybe some internal members want to pump more oil.
Okay, what's the second factor?
The second one is more concrete. It's news that Iraq's Ceyhan pipeline is apparently set to resume flows.
Ah, the Ceyhan pipeline. Remind us why that's significant.
It's a major export route, runs through Turkey, carries oil from the Kurdish region of Iraq, hundreds of thousands of barrels a day, historically. If that comes back online fully, that's real. Physical barriers hitting the global market. And that can offset a lot of the demand worries we've seen. Measurable supply.
Okay, that makes sense. But let me just push back slightly here. We've got the Middle East risk. We've got U.S. shutdown risk. Isn't that fear premium potentially stronger than these potential supply increases? One pipeline starting up, maybe OPEC Plus might increase quotas.
That's the million-dollar question, isn't it? Right now, the market seems to be leaning towards the supply story having more immediate weight. But you're absolutely right about the risk premium, and that is exactly why gold is staying so well supported. Yeah, it hit another all-time high briefly, then slipped back a bit, probably some profit-taking. But the underlying support is strong. You've got the slightly softer dollar, you've got the geopolitical tension, and the U.S. fiscal worries. Gold loves that mix. It's the go-to hedge.
Right. And beyond oil and gold, base metals were kind of mixed. Copper held up okay. But iron ore had a very specific issue.
A perfect example of a localized dispute hitting a global price. Reports came out that China has apparently banned all cargoes from BHP.
BHP, the mining giant.
One of the world's biggest iron ore suppliers. And China is the world's biggest buyer. So a major supplier reportedly cut off from its biggest customer over a pricing dispute. That immediately hits sentiment and pricing for iron ore, even if other metals aren't doing much. Shows how targeted these things can be.
That dispute really tees up our next big theme, trade policy. I feel like it's back with a vengeance, but in a very targeted way.
Definitely. Not broad tariffs across the board, but specific sectors getting hit and hit hard. The focus is very granular.
Let's run through some specifics from the briefing, because these affect everyday goods, starting with construction materials.
Yes, President Trump signed a proclamation putting a 10% tariff on softwood, timber, and lumber imports. That starts mid-October.
Ouch. That feeds right into housing costs.
Directly. And it wasn't just a flat 10%. It also mentioned caps, like 15%, for wood coming from the EU and Japan under existing deals. So it's targeting specific sources.
Trying to encourage domestic production, presumably, or force negotiations?
That's the likely goal.
Yeah.
But the really eye-watering increases are in home furnishings.
Yeah, talk about those. Vanities, kitchen cabinets.
New 25% tariffs on those kick in very soon, October 14th.
25% is already significant.
And that's just stage one. The briefing confirms the plan is for tariffs on imported cabinets to double from 25% up to 50%.
50%.
50%. And also, tariffs on some upholstered furniture go up from 25% to 30%. Both those big jumps are scheduled for January 1st unless some kind of deal is reached beforehand.
Wow. Okay, stepping back, what does a 50% tariff on something like kitchen cabinets actually do to the market? That's not just noise.
No, it's a huge distortion. It puts immense cost pressure on anyone importing those goods, builders, retailers. Ultimately, that cost gets passed on to you, the consumer, if you're buying or remodeling. It forces companies to very quickly rethink their supply chains, either find new suppliers outside the target country, or prices for those imported goods just have to shoot up. It directly fuels inflation in that specific sector.
So that's the unilateral action from the U.S. targeted protectionism. But the briefing also mentions cooperation elsewhere.
That's the other side of the coin. While the U.S. is doing this, the EU and U.S. are actually signaling deeper coordination for the future, specifically on steel.
Steel? What are they planning?
Trade Commissioner Ufechovic says they'll propose post-2026 safeguard measures very soon. And crucially, they plan to use something called tariff rate quotas.
Okay, tariff rate quotas. Can you explain that simply? How's that different from just a flat tariff?
Sure, think of it like this. A certain amount, a quota of imported steel can come in either duty-free or with a very low tariff, let's say the first 1 million tons. But once that quota is filled, any steel imported above that amount gets hit with a much, much higher tariff.
Ah, okay. So it allows some managed trade but protects domestic producers from a flood of cheap imports.
Exactly. It's a more nuanced tool. So you see these parallel tracks. The U.S. imposing sharp unilateral tariffs on things like cabinets, while simultaneously coordinating with the EU on these more complex quota systems for core industries like steel to manage global overcapacity longer term.
Okay, fascinating. Finally, let's pull back to the big picture risks. The briefing flags 3 major geopolitical threads, just keeping everything on edge.
Yeah, these are the background factors that add that sort of constant volatility premium to everything.
First up, The U.S. government shutdown risk. Talks happened, but no breakthrough reported. And here's a really tangible impact for you, beyond just market jitters. Major airlines are warning a shutdown could seriously strain aviation. Staffing issues. Fewer air traffic controllers, fewer customs agents working potentially. That means delays, canceled flights. Real economic friction.
Right, not just an abstract financial market thing. Detail number 2, Middle East uncertainty.
Yeah, sources are cautious. Still no certainty Hamas will actually accept the proposed ceasefire deal, even with Arab state backing.
Which means that acute conflict risk, the potential for it to widen, it just hangs there. Supports oil prices, supports gold.
Definitely. And the third thread, Europe's east, the war in Ukraine.
Still very much ongoing. President Putin reiterated Russia's aims, while Kyiv reported more overnight attacks, including strikes aimed at energy infrastructure again.
So you put those three together. Fiscal uncertainty in the U.S., acute conflict risk in the Middle East, and a major war impacting energy in Eastern Europe.
And it paints a picture of a pretty volatile operating environment. It explains perfectly why something like gold, even with some profit-taking, remains so fundamentally supported. The underlying risks are just too high.
Okay, so we've covered a lot. Central bank signals from Japan and Australia turning hawkish, potential new supply hitting crude oil, those really steep new U.S. tariffs on lumber and cabinets, and these 3 big geopolitical hotspots.
It is a lot. I think the key takeaway for you is how much policy and specific disputes are driving the macro narrative right now, maybe more than broad economic trends sometimes. Looking ahead, the things to watch immediately are upcoming U.S. consumer confidence and job numbers, those D.C. shutdown talks, will they find a fix, any clear signals from OPEC Plus on production, and more commentary from central bankers in Europe and Australia.
All right. And before we wrap up, a final thought for you, our listener, to chew on. We talk about the U.S. and EU coordinating on steel for post-2026, using those tariff rate quotas to handle overcapacity. So think of that joint approach. Which other major global manufacturing sectors, one's also currently struggling with massive overcapacity, maybe things like electric vehicles or advanced batteries, perhaps certain chemicals, which might be next in line for that kind of coordinated U.S.-EU trade action down the road. Where else might they team up to manage global supply gluts? Something to think about. Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.